For years, the playbook for business growth was simple: expand, scale, and capture more market share as fast as possible. New locations, new markets, new hires. Growth wasn't just a goal, it was the expectation. But in 2026, something very different is happening. Across industries, companies are quietly, and sometimes very publicly, putting their expansion plans on hold. Projects are being delayed, new markets are being reconsidered, hiring is slowing down, and in some cases, businesses are pulling back entirely. At first glance, it might seem surprising. After all, expansion is how companies grow. So why would so many of them suddenly hit the brakes? The answer lies in a combination of pressure, uncertainty, and a major shift in priorities. One of the biggest reasons is cost. Expanding a business has always been expensive, but now those costs have become far less predictable. Construction costs are volatile, labor is more expensive, financing is tighter, and supply chains, while improved from previous years, are still not as stable as they used to be. That means the margin for error is shrinking. In the past, companies could afford to take risks on expansion because growth would often cover mistakes. But today, a miscalculation can be far more damaging, and that's making businesses more cautious. Another major factor is demand uncertainty. Companies are no longer confident that demand will keep rising at a steady pace. Consumer behavior has become harder to predict. Spending patterns are shifting, and in some cases, demand is softening in ways that aren't immediately obvious. This creates a risky environment for expansion, because when you expand, you're making a bet on the future. You're assuming that demand will be there to justify the investment. Right now, that assumption feels less certain. So instead of expanding aggressively, many businesses are choosing to wait and see. There's also a financial reality that can't be ignored. The era of cheap money is largely over. Borrowing costs are higher, and access to capital is more selective. Investors are no longer rewarding growth at all costs. They're demanding efficiency, profitability, and discipline. This shift is having a huge impact on decision-making. Expansion used to be seen as a sign of strength. Now it can be seen as a risk. Companies are being asked tougher questions. Will this expansion generate real returns? How long will it take to pay off? What happens if conditions change? And if the answers aren't clear, the safest move is often to pause. At the same time, there's a growing focus on internal optimization. Instead of expanding outward, many businesses are turning inward. They're looking at how to improve efficiency, reduce waste, and get more out of what they already have. This shift is subtle but important. It means growth is no longer just about getting bigger, it's about getting better. And for many companies, that's a more immediate priority than opening new locations or entering new markets. Technology is also playing a role in this shift. With better data, analytics, and forecasting tools, businesses have more visibility into their operations than ever before, and what they're seeing is making them more cautious. They can identify inefficiencies more clearly, they can see where margins are under pressure, and they can model scenarios that highlight potential risks. In other words, they're making more informed decisions, and those decisions are often pointing toward restraint. Another factor that's easy to overlook is operational complexity. As companies grow, they don't just get bigger, they get more complicated. More locations mean more logistics, more employees mean more management challenges, more markets mean more regulatory and cultural differences. In a stable environment, this complexity can be managed, but in an uncertain one, it becomes a risk, and that's leading many businesses to rethink whether expansion is worth it right now. There's also a strategic shift happening in how companies think about growth. Instead of chasing rapid expansion, some are focusing on resilience. They want to build businesses that can withstand shocks, adapt to change, and maintain stability even in difficult conditions. And that often means being more selective about where and how they grow. Rather than expanding everywhere, they're choosing to focus on their strongest markets. Rather than opening multiple new locations, they're investing in improving existing ones. This is a very different approach from what we saw in previous years. Another important piece of the puzzle is competition. In many industries, competition has intensified. New entrants, digital alternatives, and changing customer expectations are making it harder to stand out. Expanding into a new market is no longer just about showing up, it's about competing at a high level from day one. And that requires significant investment, both in terms of money and execution. For some companies, the risk of entering a highly competitive market right now simply isn't worth it. Interestingly, this doesn't mean businesses are giving up on growth altogether. It means they're redefining what growth looks like. For some, it's about increasing profitability rather than revenue. For others, it's about improving customer retention instead of acquiring new customers. And for many, it's about strengthening their core operations before taking the next step. In other words, growth is becoming more strategic. But there's also a psychological element at play. When uncertainty is high, caution tends to increase. Even companies that have the resources to expand may choose not to, simply because the environment feels unpredictable. And when enough businesses start acting this way, it creates a broader trend. Expansion slows down across the board. This has ripple effects throughout the economy. Fewer expansion projects mean less demand for construction, fewer job openings, and slower activity in certain sectors. It also affects suppliers, partners, and entire ecosystems that depend on business growth. So this shift isn't just happening at the company level, it's shaping the broader business landscape. And yet there's an interesting twist. Periods like this often create opportunities. When most companies are pulling back, those that are willing and able to move forward carefully can gain an advantage. They can enter markets with less competition, secure better deals, and position themselves for the next phase of growth. But that requires confidence, discipline, and a clear strategy. Because expanding in this environment is not about speed, it's about precision. So where does this leave us? In 2026, expansion is no longer the default move. It's a calculated decision, influenced by cost pressures, demand uncertainty, financial constraints, and a shift toward efficiency. Businesses are not abandoning growth. They're just being far more careful about how they pursue it. And in many cases, that means pressing pause, not because they don't want to grow, but because they're waiting for the right moment to do it.